Good afternoon and welcome to the Time Finance PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. I would now like to hand you over to CEO Ed Rimmer. Good afternoon, sir.
Thank you, and good afternoon, everybody. And thanks for joining the most recent update from Time Finance. I'm going to take you through an update on the business in terms of the strategic progress we've made over the last half of our year, first half of the financial year, and then James is going to take you through the numbers for H1. I'll come back in at the end just as a summary. We found that the last presentation that we did in terms of some of the slides by way of detailed background on what we do, who we are, the products we do, it was better to put those as an appendix at the end. So we've done that again for this presentation. So if people do want to have a bit more detail on that, it is at the end of the presentation and will be available after, but we aren't going to go through that in great detail. So just by way of introduction, I'm Ed Rimmer, Chief Executive. I've spent just over 25 years in and around the financial services market, lending mainly to SMEs. I spent a small amount of time within that period within Bibby Lines Group shipping business. And I spent 22 years overall with Bibby, 17 years in the financial services business, and 5 years of that time as UK Chief Executive. I rejoined Time Finance about 18 months ago in June 2021. James.
Thanks, Ed, and good afternoon, everybody. I'm James Roberts. I'm the CFO. I've had about 20 years in financial services, of which 9 or 10 have been in the lending game. I've been with Time Finance now as the CFO since May 17, so just coming up to 6 years. Back to you, Ed.
Thanks, James. So I think we're going to switch our cameras off now just to enable us to concentrate a little bit more on the slides. Thank you. So I'll take you through the next few slides and then James will come back on with the numbers. So just a recap of our medium-term strategy that was put in place 18 months ago when I returned to the business. What did we set out to achieve? Well, become a nationally recognised SME funder. That was very much on the back of the business previously being called 1PM PLC and a collection of different brands. So we set ourselves a target to become more well-known in our core introducer market as Time Finance. The second objective was to more than double our gross lending book to 250 million. Thirdly, to achieve profits organically in excess of where we were pre-COVID. And then finally, to significantly strengthen our balance sheet, predominantly by focusing on own book lending. So what have we achieved in terms of the first half year to November 22? Of course, that should say, apologies, there's a slight typo there. Well, I'm pleased to say that the last 6 months has really been great progress and testimony to the work that we did prior to that in terms of the changes we made to the business. As you can see there, the gross lending book has, for the first time, surpassed 150 million, up to 153 million at the end of November. And that's a 32% increase from where we started off 18 months ago, and a 12% increase alone just in the first half of the year. So really pleased and good progress there. That growth has been driven predominantly by hard asset finance and invoice finance, as you can see. Hard asset, we started off with a book of 32 million 18 months ago. That's now up to 50 million, and it's increased from 40 million since the start of the financial year. And invoice finance had some significant growth since the lockdowns ended. We had a number of clients who kept their facilities in place but didn't utilise the money. Once the government funding started to end, those clients started to draw money down again. So we've seen a big increase from the low that we had, mid 20 million at the height of COVID. And that's nearly doubled back up to just under 50 million, as you can see, over the last 18 months. and we've seen a 14% growth just in terms of the first half of the year. So some really good growth in the lending books, which we're pleased with. Some other points just to note are unearned income. So that's the income we book as part of arranging leases and loans. It gives us future visibility, which is important, obviously, in terms of how income is going to fall into the profit and loss account. As you can see there, that's increased from 32% from 14.3 million up to just under 19 million at the end of November, and from 16.8 million from the start of the financial year. The net tangible assets as well have grown, pleasingly, obviously, on the balance sheet, a result of that increased profitability. Just under £4 million increase from the start of the plan, which is great to see. And pleasingly as well, the growth has not been at the expense of increased net arrears. You'll see there that the net arrears have actually reduced. We started off 14.2 million at the start of this current plan, and we've actually seen just under a 40% reduction. And pleasingly again, even with the difficult economic climate that we've had in the first half of the year, we have still seen a slight reduction in the arrears from 9.3 million at the start of the financial year. So that's another really positive marker that we're pleased to see. How has this all been achieved? So this is not an exclusive list. It's some key points that I've picked out to share today. So the focus has been very much on the core business. So that's the four key lending divisions. Sorry, the three key lending divisions: asset finance, loan finance, and invoice finance, from four key locations. So we're now located in Manchester and Warrington in the north, and Reading and Bath in the south. We've exited the loss-making second-hand vehicle broking business in April last year, that was based in the northwest, and we've also divested of the consumer mortgage business that was based in Cardiff in October last year, and more latterly in December just gone, we've exited the unsecured loans market, the small loans that were secured solely by personal guarantees, and competing with a number of volume players who don't make an awful lot of money. We've decided to exit that. So the focus has been very much on core business, asset finance, invoice finance, and loan finance. And to a large extent, that plan has now been completed and delivered for us to move forward with those three key divisions. We've also invested in some proven industry leaders. I've mentioned this in the past. We took on Steve Nichols to head up the asset finance business just over 12 months ago now. Steve's made a really good impact in the business and the asset finance division. As you can see, particularly the hard asset finance is going well. We took on Paul Seddon in the middle of last year, a very experienced risk professional in asset finance. That's a really important role because it's not just about signing off files. It's very much around structuring deals in conjunction with the sales guys and the brokers. And that enabled us to take on a little bit more larger deals through Paul's experience. And we've taken on more recently Louise Ikomedes in September in a business improvement role. So this is focused very much on the operational and efficiency and systems side of the business. We recognise we need to make some improvements there. And until we really took on some dedicated resource, it wasn't going to have the focus it needed. So 3 to 4 months in, Louise is doing well, and we've got a short-term plan of areas that we need to improve on between now and the end of our financial year. And as part of our budgeting process, we're looking to put some further investment into the business as part of the budgets for next year. We've further developed our product offerings. So we've developed an asset-based lending product, which was launched in November. So that's very much knitting together our core offerings of asset, loan, and invoice finances as one, so that we can sell more products to the same customer and keep customers for longer, and appeal to a slightly different market. And we're looking to push on with that over the next year or two. We've developed our secured offering as part of moving away from the unsecured loans market. We very much see the future of that product being in the secured market. We were only really able to provide capital and interest repayment, amortizing loans in the normal 3 to 5 year standard loans. What we will now be able to do through the results of some changes in some funding is offer short-term secured loans, anything from 3 months up to 12 months. And that's very much taken us into the bridging market and short-term cash flow needs, all secured against property charges. So we're looking to move on with that when we launch it in February. And the soft asset finance, which is still a part of the business, it provides us with a natural hedge. It's smaller deals, higher rates. We launched a fast track offering, which was to progress deals quicker through the pipeline because there's more of them, and that's performed well. We've just undertaken a review since that product was launched in April last year. I'm pleased to say that it's relatively early days, but the risk reward balance is working. So that's developed quite nicely as well. And in terms of our brand, we've definitely increased our profile. We've decided to take a sponsorship opportunity to be a sponsor of the National Association of Commercial Finance Brokers, where a lot of our members are part of during 2023. We've been shortlisted for a number of awards through Business Money Facts and the NACFB, and we were ranked joint first in the Business Money Intermediary Index for the invoice finance business during last year. So the Time Finance name and brand recognition has definitely improved since the days of 1 p.m. I think at that point it's time for me to hand over to James.
Thanks, Ed. That's great. Yes. I'm just going to do a whistle-stop tour of the interim numbers, focus on a few key metrics, and try and bring a few of the numbers to life. So at a high level, and this is very similar to the RNS that went out this morning, if you've had a chance to look at that, at a high level, all our key fundamentals in terms of the numbers have moved in the right direction during the first 6 months of this financial year. You'll see the right-hand side of the slide there, all with nice ticks next to them, which is great to see. Our own book origination, very much part of our strategy, as Ed's alluded to focus on own book lending. So the origination sourcing of those deals, in effect, has increased by 27%. And coincidentally, that has resulted in the lending book itself increasing by 27% as well from the year before. So we stand at just under 153 million now, up from 120.5 12 months earlier. As Ed touched on some of his slides, the unearned income, that's future interest that will drop into our P&L over the coming months and years, assuming deals perform well, has hit a record high, 18.9 million. That's 32% up on a year before. So we've got a record lending book and we've got a record unearned income as at the 30th of November. So that's particularly pleasing. Again, as Ed touched on, it's arguably easy to lend money. It's harder perhaps to get it back. And so the deals in arrears continuing to reduce while the book grows is particularly pleasing for us. So we had 8.7 million of deals in arrears at the end of November. Now, that's not to say they're going to be written off by any stretch of the imagination. We get pretty good recoveries, particularly on soft assets. Around 70% of those we will recover. And the hard assets, we can sell the assets and recover there. So it's just ones that aren't perhaps paying as we'd expected. But at 8.7 million, that's the lowest figure we've had since January 2019. So 4 years ago or so. And that's a 17% reduction, while the book has increased by 27%. So that's particularly pleasing for us. Again, Ed touched on it, but the balance sheet has continued to strengthen. Tangible assets now just shy of 60 million at 59.7 million. That's 3% up on a year before. Probably more important and of more focus is net tangible assets because of the historic buy and build. There is some goodwill in the balance sheet, but the net tangible assets now at 32.1 million. That's 8% up on the period, the figure 12 months earlier. And the P&L is moving in the right direction as well. Revenue for the period, 13.2 million. That's 12% up on the 6 months from the year before. And PBT up to 2 million from 1.2 million. So a 67% increase. And all of that's reflected in the earnings per share, which are 62% up at 1.73 pence per share. So numbers wise, in terms of deal flow coming in, strength of the balance sheet, deals going wrong, and the P&L, all very pleasing for those first 6 months. we look at the balance sheet in a little bit more detail, the two tables on the left are more takeaways showing how the net tangible assets have increased and the gross lending book has increased. The graphic on the right hopefully brings to life the arrears position. As I've said, it is key for us and an area of great focus. But if I split this graphic from January 2019 through to November 22 down into three parts, they tell three distinct stories. The first third on the left-hand side is effectively the traditional arrears run rate pre-pandemic. Remember, we're lending to UK SMEs. There will always be some deals that go into arrears and some in the end may be written off. As I've said, these don't necessarily result in write-offs, but they're an early indicator. We can see there for that period pre-pandemic, we were running along at roundabout on average 15 million. It was about 10% of the book back in the day. We then had COVID hit, and you can see the big spike in the 2020s. As you'd expect, there was an increase in traditional arrears, which is the purple bar. And also we agreed with some clients to give them forbearance, maybe an interest payment holiday or just a complete payment holiday or whatever on a case-by-case basis. And you can see that green addition to the bars there was the forbearance during COVID. Then we move on to the final third of the graph, and we can see for pretty much the last 12 months, the forbearance has completely gone in relation to COVID, which is particularly pleasing. But also, and more important, is the underlying arrears now are consistently below 10 million. They're about 6% of the book now and have been for a number of months. So we can see that although the book has grown significantly, the arrears are, as we've touched on, far lower than even pre-pandemic levels. And it gives us confidence that the underwriting and the quality of the book is better, and that sets us in better stead, we believe, moving forward. The final slide from me before handing back to Ed is just to again graphically show the book. We've said already that the own book lending is key to our strategy. It's a key driver of revenue and profits moving forward, and it has a compound effect to a degree in terms of profits over time. So the bigger the own book lending book is, assuming you've done good quality deals, the more your profit will grow as we move forward. So this here we can see we were around about 145 million back pre-COVID. Various lockdowns hit and the book fell, moved around a bit. But at the end of lockdown 3, which as you can see is around about July 21, we've had pretty much uninterrupted growth in that book month on month, every month through to now being just shy of 155 million. And fingers crossed, we don't see anything on the horizon to stop that growth continuing. So really pleased with how the book's gone. It shows people are getting the message of what we offer and how we can help UK SMEs. Just finally, some very other quick other metrics that are part of the strategy for us. We wanted to increase our average deal size, excuse me, to move into perhaps better quality, slightly larger ticket deals. And we can see that when we started the medium-term plan in June of 21, the average deal size across the group was about £14,000. It's now up to £27,000. Now, we don't want to completely change it and have an average deal size of hundreds and hundreds and thousands, but we want to tick it up a little bit bigger as we move forward, but it's certainly going in the right direction. So that's pleasing. At the same time, we've continued to focus on spread. Risk diversification is absolutely key to us as a business. And we can see that the top 10 sectors by value remained less than 30%, which they have historically been. And the largest sector by value is less than 10%, which again, it's historically been. So we're not focusing just purely on one sector. We're spreading the risk across multiple industries. We feel we've got a sensible approach to provisioning. Bad debt provision is about 3% of the book, and all other things being equal, continue to be at about that level. So we feel that's a good, solid approach to provisioning. And we have managed to pass on most of the recent interest rises to our clients, with an average of about 2% increase in the rates we've charged recently over the last few months. So invoice finance, for those of you who aren't aware, is a variable rate funding and variable rate funding in and funding out. So the interest rates are automatically passed on. Asset and loan funding is fixed in us drawing our funding. So our back book is completely fixed, both on on the rates we brought in, but it's also fixed in lending to our clients. So as we draw down new funding or new lends, our funding costs have marginally increased. But as this shows, we have managed to pass the bulk of that those increases onto our clients, so maintaining our net interest margin. So in summary, we think it's a really good first 6 months numbers. It has resulted in us being able to uplift our market expectations for the full financial year, which is in the current environment we're very pleased to do. And we think the foundations and the building blocks are there to continue the growth for the rest of the medium-term plan. And with that, I'll hand back to Ed.
Thanks, James. So just to take you through the final slide before we open the floor to any questions. In terms of a summary of the first half of this year, we've exited the non-core businesses now, and that's that exercise is complete. We believe that we've tidied up the business, for want of a better word, and positioned the business as the way that we set out to do so. So that is now done. The key hires that we took on are embedded in the core parts of the business. We don't envisage that there will be any senior additional hires this year. Of course, we will look to increase the staff as we grow the business, but in terms of the leadership team, that is now complete. The multi-product offering is expanded, as I mentioned, with the launch of our ABL products and the moving away from the brokerage businesses to be purely focused on own book lending. As the following point says, that's mainly in hard asset and invoice finance, but also with our smaller soft asset product to provide us with a spread of deals and also increased rates at that end of the market. And as James said, we have focused heavily on maintaining our net interest margin as we've seen interest rates increase. And pleased to say that so far has been done largely through passing on the rates to the customers. And we've been very pleased with the Time Finance name being more recognised in the market, particularly in our core broker market and our introducer market. And we are getting now further recognition. We're able to put more material into the market from deals that we've done, and I think that's going in the right direction. So in terms of outlook, how do we see things? Well, very much continuing on the focus of our core strategy. We're 18 months into a 4-year plan, and plenty still to achieve, but I think we're broadly on track as to where we set out to be. The market conditions clearly remain challenging. They're very difficult to forecast. The last 6 months of the calendar year that we've just gone through, who could have thought the things that businesses would have had to focus on the back of coming out of COVID. So I've probably, as I said before to someone when we were talking, given up on actually trying to forecast too accurately how things will pan out in the future. And challenging is probably the right word, but clearly this presents opportunities for businesses like ours. Alternative financiers have always done well, certainly in my experience, through times of boom and bust. And clearly we have a situation at the moment where government funding is no longer available to the extent that it was for small businesses. And therefore external funding will be required. And that's where we feel we're well positioned. So our medium-term aims remain the same. We've got some positive momentum. And as James mentioned, we do now expect to exceed the original market guidance that we put into the market of 2.8 million. And that has been repositioned at 3.2 million for the time being. Yes, that could be called slightly cautious based on our current run rate. But one of the things that I wanted to do when I came back into the business and the board supported was to build credibility and confidence back for Time Finance, certainly as a result of the COVID reductions in our volumes. And I think that's what we're focused on doing. So hopefully we will continue the momentum through the second half of the year and deliver what we think we can achieve as a minimum now for the full year. Okay, thank you.
Ed, James, that's great. And thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the top right corner of your screen. But just while the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Ed, James, as you can see, we have received a number of questions throughout today's presentation, and thank you to all investors for submitting their questions. James, if I could just ask you to read out the questions and give responses where appropriate to do so, and I will pick up from you both at the end. Thank you.
Yes, thank you. So I'll steer the ship through this and then bring Ed in on the questions for him, if that's okay. So the first question from Jake, and it's probably one for you, Ed, if that's all right, is, hi, when do you think you will be paying a dividend next?
Yes, so this has been a frequently asked question and also a frequently debated subject within our board. We are still making the decision to not pay a dividend. We have paid small dividends in years gone by. We believe that the money is better spent and better used investing in the current business. And this is very much seen as an investment growth stock at the moment. That may change. We're certainly keeping it under discussion at the board, but for the time being, we believe that the dividends that if we did pay them would be so small anyway. As I say, the money is better put to better use by keeping it in the business and investing, supporting the balance sheet, and supporting the debt lines that we have to grow the business. So that's the current stance that we're taking.
Thanks, Ed. The next question from Colin is actually 4 questions, so I'll take them one at a time if that's all right. I think most of them are aimed at you, Ed, but just going through them. Question 1, now that you virtually don't use brokerage lending and recruited your own sales heads, where do Time get their leads from?
Well, we do use brokers and we do use intermediaries, so that's our core channel to market. The sales guys are basically tasked with forming relationships with those intermediaries and getting business from them. It works slightly differently in the different products. So the asset finance brokers do package a lot of the deals, but they still need managing in terms of our proposition, the business that we want, the business that we don't want, and really having a deep understanding of how we underwrite business. So that's the broker manager's job. In the invoice finance world, the broker doesn't necessarily package the deal as such. That's the salesperson's responsibility to do in conjunction with our audit teams. So we are still using introducers. We absolutely value our intermediary relationships, and that's key to our growth. So we don't see any change there in the immediate future.
Thanks, Ed. And Colin's second question was, do you advertise or attend trade shows? I've never seen a Time advert.
Well, that's a good question, because we haven't put an awful lot of investment and time into trade shows. We felt that we had enough coverage through our salespeople and the core relationships to get the business moving again. And I think we've done that. We have attended the NACFAB show at the NEC in Birmingham for the last 2 years. We've had a great stand there. That generally sees upwards of 500 people come through the doors in the single day that it's done in June. So we have been present at that key industry event, but there's more that we could do there. And that is part of our plan for the marketing budget when we look to put it in place for the next financial year, which obviously starts on the 1st of June. So we'll be putting the planning into that as we travel through the spring. So hopefully you'll see us a little bit more recognition in some trade shows.
And the third question from Colin was, existing customers are less costly to get. What are your retention rates?
So the retention rates, I'm pleased to say, are really good. With the asset finance business, businesses generally stay for the term of the agreement. So you put in place a 3-year lease. They stay for the period of that time. And obviously within that time, we hope to get other assets that we fund as well through the broker relationships that we have. Sometimes the relationships pay up early because they to have a change of circumstances, they refinance, a whole numerous reasons, but that's not a core part of what we do. The invoice finance relationships can move around, but we have one of the highest retention rates in the industry. So our average client life is around 4.5 to 5 years in the invoice finance market. When I was in Bibby, the average retention was around 2 years. Slightly different market then, but that gives you a very broad overview of where we sit, and we put a lot of emphasis on retaining existing clients. It's a core part of what we do. It costs an awful lot to get a client, so we want to keep it as long as we can.
Thanks, Ed. Last couple of questions from Colin before we move on. His fourth one is, what are the cross-selling rates? I'm not sure if that's, I assume that's how much we've made from cross-selling rather than the rates we're charging.
Yeah, well, if I can just talk about that. So the cross-sell opportunity is there in this business, and we have put quite a lot of emphasis around it. We put a scheme in place actually prior to COVID called Excel, but it inevitably died a bit of a death during COVID. We relaunched it when we came out of COVID as part of our relaunch strategy, and we have had somebody within the business that's been responsible for developing Excel. We do regular staff forums, we do regular training sessions in terms of product development and the offerings and how they change. We've got an all-staff conference coming up in March where we're going to be doing some more on Excel, and it is a key part of the future plans for the business in terms of our multi-product offering. We have had some success with the program. We've done around 40 transactions from existing clients onto other products since we started it. That's in the last 18 months, and we're monitoring the lifetime income that we get from those clients, and the conversion rates, and where we get business and where it goes to in the various divisions. So yeah, it's an initiative that's I would say going okay. It could go better with a bit more emphasis behind it, and that's one of our objectives for the next 12 months.
Thanks, Ed. Final question from Colin. Do we exclude SMEs by size, say turnover too large for us or too small for us?
We do. We typically look at the minimum rate, the minimum value that we will lend, and this is not normal, but it's occasional at the small end of the soft asset market, as low as £1,000. At the top end of the market, it's 2.5 million. That's our self-imposed limit that the board have agreed to, and that our back-to-back providers in the invoice finance division, where that limit applies, have agreed to as well. The asset finance maximum exposure that we'll go up to any one client is 750k, and that's a fairly recent uplift from 500k that we had in place prior to that. Secured lending on the loan side is 500k as a minimum. So that gives you some parameters that we're working to. It's typically lending to businesses that turn over up to 5 million in the SME space.
Thanks, Ed. So a question from Mark. Do you believe it's inevitable that non-performing loans will increase given the economic environment? What sectors are likely to concern you the most in the next 12 months?
Well, I think I'll take that one, James. I think it's inevitable that we will have bad debts. It's inevitable for every financier that lends to small businesses, and actually anyone that lends money at some point will have bad debts. The key is to control those to a manageable level, and that's where we believe we have not a competitive advantage, because there's other businesses that have very good people working for them, but we very much rely on the experience and knowledge of our people, and that's a key part when you're lending to SMEs. Systems can only go so far. We're looking to improve our systems. Clearly, we need to make some improvements in efficiencies. We have had some inherent different systems from the acquisitions that were done in the 1PM days that we have made some progress with, and we need to make some further progress with. But the fundamental difference for this and similar businesses in alternative lending is the people, and having the right experience, credibility, people that they can call on as contacts as well in the support sector. So insolvency practitioners, turnaround consultants, solicitors. That's really all important when we go into times of difficulty. And I think we will take bad debts inevitably. It's the way that we control those. And of course, the opportunities that we can take at the front end. And the key is to make sure that you make the most of the opportunities, and that outweighs the likely increase in bad debts that you'll have during difficult times.
Thanks, Ed. Sam asks, it's great to see full year trading will be ahead of market expectations. How have our competitors fared?
Well, we have very few competitors in the listed space that do the same as us. So there's one or two, but there's very few in the listed space that do all the products we do. So there may be some listed businesses that do asset finance, but there's very few that do the combination of products that we do. So it's sometimes difficult to compare against in terms of the availability of data. We monitor the industry stats for the invoice finance market through UK Finance, who publish stats every quarter, and we monitor our stats for asset finance through the Finance and Leasing Association, who also issue their stats every quarter. But there's very different segments of those markets, and they're quite wide ranging. We've just done some data against a couple of our key competitors, and I'm pleased to say that they're fairly favourable. In fact, we've outperformed some of our key competitors in the alternative lending space as independent businesses. But I would caveat that we are coming from a lower base, not significantly lower. We're not comparing ourselves, with billion-pound balance sheet businesses. We're trying to compare ourselves with businesses that we're aspiring to be like. And we've outperformed those businesses in the last 12 months, but we are coming from a slightly lower base. That's why I think there's an opportunity for this business, because we don't need to take over the world. We can take a relatively small part of the markets that we're in and still grow this business. So I think that's an attractive part of the growth plan that we've got.
Thanks, Ed. Peter asks, do you think the trend in net arrears can continue to reduce given the macroeconomic background? Or to put it another way, do you think we've reached a steady state?
Do you want to take that one, James, and give me a break from talking?
Okay, yeah, no worries. I think it's a very good question. I think Ed alluded to it earlier. We're in the lending game. There will be bad debts. There will be deals that go wrong. The macroeconomic environment is tough, as we know. So I suspect the arrears falling in pounds and pence is in quantum. I think we've probably bottomed out. There'll always be a level of arrears we have as a business. Our challenge will be to keep those arrears in a range we think is reasonable. It's about 6% now. If they stay at about 6 or 7% as the book grows, I think that would be a good result. The other thing as well is, as I touched on right at the beginning, arrears don't necessarily mean write-offs. They're an early indicator, but we have a very experienced and skilled collections team, recovery team, and we have a pretty good track record of getting a fair amount of our deals either back on track or our funds recovered. So, we're watching this all the time. But I don't think, if you look at the stats, it's fallen from 14 million to just under 9 million in a year. I'd be delighted, but I don't think we'll be turning around in a year's time and saying we're now at 4 or 5 million. I think that would be unrealistic. Mark asks, can you give more color on how you fund the books and if this will change in the future? So probably another one for me here, Ed. So we've two very distinct funding lines for each of our key divisions. So invoice finance is funded by a back-to-back facility with RBSIF, who are one of the biggest, if not the biggest, players in the market. That's a 42 million facility with an 8 million accordion. And that is variable funding. So the funding we draw down is variable, but also the funding we provide to our clients is variable as well. So the rates, he says somewhat flippantly, are largely irrelevant for us because we just pass on any rate increases. It's slightly different in asset. They're funded by block funders, which are wholesale lenders. We've got a panel of about 6 of those, half a dozen or so, the likes of Aldermore and Investec and Siemens, who have 10 to 20 million facilities with us, and the government-backed British Business Bank as well are one of our funders. Those rates, those funds are fixed. So when we fix our deals, we then bring the funding in, who will fund 80 to 90% of those deals. So the rate we charge is fixed, as is the funding we draw down at the point we draw it down. Obviously, as rates have increased, our back book then is not exposed to the interest rate rises, but future funding is. So our typical rate is about 3.5 or so, 4% above base is what we'd draw our funding down. So as rates go up, that obviously goes up, but it's about 3.5 to 4% above base. We obviously charge on a much higher margin to our clients. And as I said, I think earlier, we've managed to pass on around about 2% on average of the rate increases to our clients. We don't want to become uncompetitive and pass on too much. At the same time, we don't want to stop pricing in risk and reward appropriately. Paul asks, please outline how you can safely maximize your available balance sheet cash to support own book growth lending and not hit a low growth ceiling. That's probably a third one in a row for me, Ed, if that's all right. That's a very good question. And funnily, we spent a long time at our board meeting earlier in the week talking about cash and how we use it. Ed's touched on, we're currently not proposing a dividend because we want to use our cash resources to grow the business. The medium-term plan, which goes to May 25, we think we can get there or thereabouts with our existing funders or maybe 1 or 2 new ones in and our own cash reserves. We certainly don't think for the next 12 to 18 months there would be an issue. I think if we grew super fast, it could put a strain on the cash because obviously we have to fund that 10 or 15% equity slug. If we grow steadily and securely as we have done for the last 18 months and carry on that for the next 2.5 years, we will have the resources and the cash juggling it around and stuff to hit our medium-term plans. So it's all about the speed we grow at, and the speed we're growing at the moment is very much within our means. Another question from Paul. Following on from the above, how is the search for suitable long-term liquidity at sensible pricing over the course of the next 12 to 24 months stated in the financial year 22 report going? So I've sort of answered that. Yes, we very much have been looking at that. We're always talking to funders, variety of funders from RCFs to mezzanine and everything else out there, seeing what best suits us. At the moment, we're doing better than we thought on certain cash flow assumptions, less deals in arrears, et cetera, et cetera. So we've got more cash to play with. So we're constantly talking to people, but it's less, I suppose, of a pressing need than it was maybe 12 months ago. Another question from Paul. This one's probably one for you, Ed. How is morale holding up given so much upheaval? COVID and then changing corporate goals style will have created some discombobulation. It's a word I've not heard for a while.
Yeah, and that's, yeah, I think that's a good question. We mentioned it actually on the last presentation that we were intending on putting quite a lot more focus around our people and colleagues around the business, and we've done just that. I think we started off the year by having a set of objectives of what we wanted to achieve, and one of those things was actually getting the teams together. A lot of people had been working from home. Most people had come back into the offices by way of flexible working, which we've carried on, which seems to work for our business, and it seems to work for our colleagues. And we wanted to get everybody together. So I think I mentioned earlier in the presentation, we have got a day booked in for everyone to come together in March in the Midlands, which will be the first time we've done that in 3 years. And that will be a real opportunity to get key messages across to people, but also engage with the staff and hear what they think. And and the ideas for the future. So looking forward to that. We've done a lot of work around communication. We have regular town halls with the teams. Obviously, things have changed now where people can jump on things like this, webinars, and make it easier to communicate and ask questions. We've spent more time trying to push out the results and how we're doing, because lots of people heard about things in the business, but not necessarily how we were actually performing financially. So we're doing that more. And I think probably most importantly, we have supported our colleagues with cost of living increases outside of the annual appraisal and reviews. So with all the pressure that people have had, fuel bills going up, obviously heating bills going up, inflation, we decided to provide some support to the most, I suppose, the most needy in the business, those people that weren't paid the executive salaries. So it's been very much concentrated at the slightly lower end of the workforce. But that's actually encompassed a large chunk of the people that we've got, and we employ now 130 people, and we've done that in 2 stages. The first one was through the autumn, and we decided to carry that on through the winter, and that's been really well received. So we've worked really hard on making sure that morale has improved from where it was, because we had to make some redundancies 12 months ago. And since then, gradually things have improved. And I think I've certainly spent a lot of time making sure that we understand changes that we need to make and improvements that we need to make with our communications. And I think we're on the right track there. So, lots still to do, but it's a good question. And I think we're in a better place than we were.
Thanks, Ed. I'm just conscious of time. We've got a couple of minutes before we'll have to start wrapping up and summarising. So just another one probably for you here, Ed. Could you comment in a bit more detail on what is driving growth in the main 2 products, asset and invoice, given economic conditions have been so weak? Has it been particular sectors that are growing and driving demand for loans, maybe replacement government schemes, or is growth more a function of you taking market share?
Yeah, again, good question. And mentioned a couple of key points there. So, firstly, let's be honest. The government funding schemes migrating away has helped all alternative financiers like ourselves. So that's been one key thing. There has been some sector nuances. So construction did pretty well all the way through COVID, and it had a really good run through most of last year. It slowed down more latterly. But we benefited significantly through the hard asset division, through the construction market being buoyant. Obviously, we fund a lot of yellow plants and construction equipment, crushers and the likes, and that's benefited it. And we also funded a lot of wheeled assets, where obviously through the back of COVID, people were moving more towards funding wagons and delivery vans and smaller LGVs, obviously, for the home delivery market. So we've benefited through things like that. I think the 2 divisions have made the most of those times, but they've also made the most of the opportunities through our people and engaging with the broker market and actually getting the time finance name into the markets that weren't necessarily understood clearly before then. So we have done some bigger ticket deals that people wouldn't necessarily have associated us with, and we've proved that we can play in that turnaround market. So it's a combination of things, really, but I think it comes down to fundamentally the market and our people.
Thanks, Ed. I think we've probably got time for one last one, and apologies for not having the time to answer them all. But John has asked if the segmental analysis shows weaker PBT margins for the 3 core businesses compared to the previous half year, particularly in IF. Comments, please. I think if I take that one, Ed, if that's okay.
Sure.
I think, John, that's probably due to a different recharge approach. In the past, we had a lot of what you could class central services, HR, marketing, IT, were held within our sort of central cost base and didn't sit within the individual entities, invoice finance, asset finance, loan finance. This financial year, we have decided to put the cost base in those businesses. So they actually are paying for the services they receive, which I think is probably the correct thing to do. So it shows their true profitability. So that has dampened the margins this year because it's not quite apples with apples. It's a very good question, though, and maybe we need to think about restating in the full year accounts the segmentals to enable a better comparison. But that's what it is. We've basically put IT, HR, marketing into the 3 divisions, whereas previously they were held within the other bucket, if that makes sense. And I think that's all we've time for on the questions, if that's okay.
That's great, James and Ed. Thank you so much for taking the time to address all the questions you can from investors this afternoon. And Ed, before redirecting investors to provide you with a feedback, which I know is particularly important to the company, could I please ask you for a few closing comments?
Yes, sure. Well, thanks again to everyone for joining and hearing what we've had to say. I think it's been a pleasing period. We did a lot of hard work in the first year that I came back into the business, and it's always nice to see the results coming through. The plan is by no means finished. We still believe there's a lot to do and a lot of opportunities for us this year and into the future. We're 18 months into our 4-year plan. But so far, so good. And as long as the market opportunities are there, I believe that we're in a great position to take them. And so, that's really, I think, the summary to leave you with. We're well set, hopefully, for the future with a slight bit of cautious optimism around, obviously, the uncertain market.
Ed and James, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I am sure will be greatly valued by the company. On behalf of the management team of Time Finance PLC, we would like to thank you for attending today's presentation. Good afternoon to you all.